Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
Okay, let's just dive right in. Thursday, January 22nd, 2026. You have to look at the tape. WORX Corp, ticker WORX. The stock surges 23.49% in after-hours trading. It hits, $0.225? But look, if you are just looking at the price, you are completely missing the actual story here. The story is the volume. We saw 2.41 million shares trade hands. The daily average is, 450,000? This is a 5 standard deviation event. The market is screaming that something fundamental has shifted.
The market is definitely screaming, I'll give you that, but I think you're misinterpreting what it's saying. You look at that volume and you see a breakout. I look at the calendar and I see a breakdown. That surge happened exactly 6 days after the SEC declared the company's Form S-1 registration statement effective. That was January 16th. So, we aren't seeing a discovery of value here. We're seeing the mechanics of a massive liquidity event just kicking into gear.
I get why you jump to the regulatory filings first. I mean, it's the safe place to look when a microcap starts moving like this. But if you ignore the operational turnaround that's happening underneath the hood, you miss the forest for the trees. The central tension here isn't just about the share count. It's whether this price surge is, a recognition that WORX has finally pivoted successfully to a SaaS model with its virtual item master, or if, as you're saying, it's just financial engineering. I'm arguing that for the first time in years, the business justification is actually leading the price action.
And I have to push back on that immediately. I'm looking at a company that has registered over 53 million shares for resale. The public float is only about, 15.8 million? That is a 3.3x potential increase in supply. You simply cannot trade on operational optimism when the capital structure is mathematically set up to crush equity holders. This isn't a turnaround story. It's an arbitrage setup designed to facilitate warrant exercises and convertible note exits.
All right, let's define the battlefield then. My position is that the market is finally waking up to the hidden value of WORX's technology. Despite all the financial noise you're focused on, the company is proving its virtual item master, the VIM, is basically the Rosetta Stone for hospital data interoperability. And we have tangible validation. There's a renewal with a major group purchasing organization that involved a 113% increase in contract value, and a massive win in December 2025 with a 500-bed Midwest academic hospital. So my thesis is simple. The operational turnaround is real, margins are expanding, slowly, yes, but expanding, and the company is securing its place as a necessary utility for hospitals migrating to Workday.
And my thesis is that the equity is completely uninvestable. It doesn't matter how good the software is, the math of the dilution is just brutal. We are staring at an S1 overhang that is, frankly, catastrophic. I believe this price surge to 22 cents is artificial. It's a likely attempt to push the stock up toward that 31-cent mark to trigger warrant exercises or facilitate some of these floorless convertible note exits. The company's in a death spiral of financing. It's facing a NASDAQ delisting deadline in April 2026. A reverse stock split is statistically probable. The business might have a pulse, sure, but the stock is terminal.
Well, let's dig into that pulse, because I think it's a lot stronger than you're giving it credit for. You have to look at this anonymous partner strategy they've been deploying. Now, I know the bears hate it when companies don't name names. It feels opaque, I get it. But look at the data points we do have. In October 2025, they renewed an agreement with an existing healthcare partner.
An aggregate purchasing group. I mean, that is incredibly vague. It's hard to model vague.
It is vague. I agree, but it is lucrative. The renewal is worth $1.692 million over the term. That's about $564,000 a year. But the critical number, the number that tells me this isn't just some legacy contract rolling over, is the 113% increase in contract value compared to the prior term. You do not get 113% uplift from a legacy partner unless your land and expand strategy actually works. This proves they're upselling new modules, maybe the rebate management or the RFP tools. This is the definition of SaaS stickiness. They are entrenching themselves.
I see that percentage, and I acknowledge it's a good headline number. I do. But let's zoom out to the actual income statement from Q3 2025. If this land and expand strategy is so powerful, why did total revenue contract by 7.1%? A growth stage SaaS company, which is how you're framing them, should not be shrinking its top line. If the product is flying off the shelves, the revenue line should be moving up and to the right, not contracting.
Well, it's a transition period. We see this all the time when companies pivot from a service model to a software model. They're shedding low-margin legacy consulting revenue for higher-margin recurring revenue. So yeah, it looks like a contraction, but it's actually a purification of the revenue stream. You have to take one step back to take two steps forward.
That sounds nice in theory, but let's look at the quality of that revenue purification. Let's talk about margins. You called them a SaaS company. True software as a service companies, they command gross margins of 70 to 80%. Why? Because once you write the code, selling it again costs almost nothing. WORX reported a gross margin of what, roughly 36% in Q3? That is not software economics. That is service economics.
It's an improvement, though.
It implies high labor costs. It tells me that their virtual item master likely still requires a lot of humans in the loop to clean up that dirty hospital data. If you have to pay a team of data stewards to fix the catalog every time you sign a new client, you don't have a scalable platform. You have a tech-enabled consulting firm disguised as a platform.
That is a fair critique of the historical data, but notice the trend line. Gross margins expanded from around 25% to 27% year over year for the 9-month period. It's moving in the right direction. It takes time to automate the complexity of a hospital supply chain. And more importantly, look at the quality of the new wins. On December 17, 2025, they signed that 500-bed Midwest academic hospital.
Okay, but why does the specific type of hospital matter? A bed is a bed, isn't it?
No, absolutely not. Academic medical centers are the whales of this industry. They have high acuity, extremely complex supply chains with research materials, teaching supplies, rare surgical implants. A small rural hospital has a simple inventory, bandages, and aspirin. An academic center is chaos. Winning a 500-bed AMC proves the platform can handle complexity that simple inventory systems just can't. It validates the technology in the hardest possible environment. If they can make it work there, they can make it work anywhere.
Look, I'm not saying the product doesn't work. I'm saying the company can't afford to run it. They raised $200,000 in November 2024. $200,000. In the corporate world, that's not a capital raise. That's barely making payroll for a month. It indicates they have absolutely no access to real capital markets. They are surviving on fumes.
Oris, they are being efficient with their capital until the larger cash flows from these new contracts finally hit the balance sheet in 2026. I mean, the 500-bed hospital deal didn't show up in the Q3 numbers you're quoting. You're driving while looking in the rearview mirror. I'm looking through the windshield.
Efficiency is not the word I would use. Let's pivot to the elephant in the room, the S1 filing that went effective January 16th. We have to explain this because it explains the price action far better than a hospital contract does. The filing registers 53.2 million shares for resale.
It's a shelf offering. It doesn't mean they're all hitting the bid at once. It just means the shares are now registered.
It effectively does when you look at the warrant inducement mechanics detailed in the filing. We need to break this down. The company issued new warrants with an exercise price of roughly 31 cents. Now, just think about the incentives here. The stock is trading at 18 or 19 cents before the spike, so those warrants are out of the money. The company gets zero cash unless the stock price goes above 31 cents.
So you think the rally to 22 cents is, what, a conspiracy?
No, it's not a conspiracy, it's just market mechanics. If I'm a financier holding those warrants or I'm holding convertible notes that benefit from volatility, I have a direct incentive to see that stock price move up. That spike on January 22nd, it really smells like speculation trying to push the price toward that 31-cent strike so the company can induce exercise and get some cash in the door. It's a trap for retail investors who see the green candle and think it's about fundamentals. They're buying the hype while the financiers are just preparing to sell the paper.
I see it differently. The volume was 2.41 million shares. That's massive. That looks like a clearing event to me. Perhaps a large legacy holder finally exited, removing a cap that had been suppressed suppressing the price for months. When you clear out a tired shareholder, someone who just wants out at any price, the stock is finally free to find its true level. The S1 might have just facilitated the exit of a problem, not the start of a new dump.
Free to find its level? The stock is non-compliant with NASDAQ listing rules. They have until April 6, 2026 to get the bid price above $1. We are sitting at 20-something cents. Organically rising 400% in 2 months is, statistically impossible for a company with negative EBITDA. This means a reverse stock split is inevitable in Q1, probably a 1 for 10 or 1 for 20.
Reverse splits are ugly. I'll grant you that. But they are technicalities. If the business fundamentals improve, the post-split stock can stabilize.
Historically, they are the kiss of death for microcaps. It just invites more shorting. And speaking of market structure, let's talk about who actually owns this stock. You've got some interesting names on the registry that people might misinterpret.
Exactly. This is where your bear case starts to crack. Look at the institutional presence. We see Citadel advisors holding somewhere between 1.5 and 2.6%. We see Renaissance Technologies, Rentech, holding about 1.1%. These are the smartest guys in the room. Rentech's medallion fund is legendary. Citadel and Rentech do not buy garbage. Their presence validates that WORX is an asset class worth watching. Why would Ken Griffin or the Rentech algos bother with a penny stock if there wasn't an edge?
That is such a dangerous misinterpretation of what those firms do. You're picturing an analyst at Rentech looking at the virtual item master and deciding it's the future of healthcare. That is not what happens. Citadel and Rentech are quantitative shops. Citadel Securities is a market maker. They are likely holding the stock to hedge against convertible notes or to simply play volatility arbitrage. They're running algorithms that exploit the spread on high retail volume. They provide liquidity. They don't provide a fundamental endorsement. They're making pennies on millions of trades, not betting on SC-WORX' long-term success.
But they're there. If this was a dead company, they wouldn't even bother. And look at the short interest. It's plummeted. Short interest dropped from 1.2 million shares in October to just 190,000 in December. The bears have covered. There is no one left to sell. That removes a massive downward pressure on the stock.
That's actually a bear signal in disguise. You're right, the short interest is only about 1.2% of the float now. That completely debunks the short squeeze narrative. There's no squeeze coming because there are no shorts left to squeeze. They took their profits and left because they don't think there's enough meat left on the bone, even for a short trade. When the shorts leave a distressed company, it's often because the company is becoming irrelevant, not because it's recovering.
Or they realized they were wrong and got out before the turnaround.
And what about the dark pools? We checked the off-exchange data for January 16th. Off-exchange short volume was only about 12%. That is incredibly low. Usually in these distressed names, you see 40 or 50% of selling in dark pools, where institutions are quietly unloading. Low dark pool volume means the selling is happening on lit exchanges, on the NASDAQ. That suggests genuine long liquidation. People are openly selling their shares. That's not hidden manipulation. That's investors fleeing.
Investors fleeing or investors rotating? Let's look at the macro picture. The healthcare supply chain is broken. We know this. The secular tailwind here is the migration to cloud ERPs like Workday. In August 2025, a Florida hospital selected SC-WORX specifically for our Workday implementation. This is the key. Hospitals are moving to the cloud. They cannot move to the cloud with dirty data. It's garbage in, garbage out. SC-WORX is the janitor that cleans the data before it goes into Workday. That makes them a mandatory utility, not some discretionary purchase.
It's a compelling narrative, I get it. But the market isn't paying for narratives anymore. Look at the valuation peers. SC-WORX trades at roughly 1 times trailing 12-month sales. Now look at Health Catalyst, ticker HCAT. Health Catalyst is a real company. Much healthier balance sheet, actual growth. They trade at half a times sales, maybe 0.6 times sales. Why is the distressed microcap trading at a 100% premium to the established player? HCAT has cash, a broad client base, and they are trading at half the valuation multiple.
Because of the penny stock premium. Microcaps always command a higher multiple on revenue because of the option value. If SC Works solves its cash problem, it could 10x. Health Catalyst is not going to 10x. You pay a premium for the potential of explosive growth. It's the difference between buying a government bond and buying a venture capital stake. You pay for the asymmetry.
You pay a premium for a lottery ticket, and right now the odds of that ticket paying off are dropping. I looked at the alternative data on Polymarket. You know how these supply chain stocks trade? They are panic beta. They spike when people are scared of shortages, like during COVID.
And we live in a world of constant supply chain threats.
Not according to the betting markets. The Polymarket odds for new pandemic in 2025 or bird flu emergency are sitting at rock bottom. The no shares are trading high. Without a macro panic to drive that just-in-case hoarding, there is no external catalyst. Hospitals aren't in panic mode, they're in budget-cutting mode. The fear trade is off the table.
I disagree with the whole premise that we need a pandemic for this to work. That was the 2020 thesis. The 2026 thesis is different. The mandate has shifted from panic to resiliency and efficiency. Resiliency is a permanent budget item now. The Affordable Care Act markets are stable. Hospital CFOs are demanding visibility into their inventory not because they fear a virus, but because they fear revenue leakage. If a surgeon opens a kit and a $500 clamp is missing because the inventory data was wrong, the surgery stops, but the clock keeps ticking. That costs the hospital thousands. SC Works stops that leakage. That 113% contract renewal proves that once a hospital uses the system, they realize they can't live without it.
They might realize they can't live without a system, but there is nothing preventing a larger player like Premier or even Workday themselves from just crushing SC Works. And that brings us right back to the survival question. The company needs cash. If they try to raise money with the stock at 20 cents, the dilution will be horrific. If they don't raise money, they go insolvent.
That's why the 31-cent level is so critical. If the stock can push through 31 cents, driven by these contract wins and maybe some institutional interest, the warrant exercise brings in the cash they need without a toxic new financing round. It's a narrow path, I admit it, but it is a path. The 500-bed hospital win gives them the credibility to walk that path. It's a tight squeeze, but if they pop through that resistance, the balance sheet heals itself.
It's not a path, it's a tightrope walk in a hurricane. You are betting on a perfect execution of warrant inducements while a 53 million share supply glut hits the market, all before an April 6 delisting deadline triggers a reverse split. The math is just overwhelming. You're asking for everything to go right in a market that usually punishes the smallest mistake.
The math was overwhelming for a lot of turnaround stories right before they turned. The business underneath is showing signs of life that we haven't seen in 3 years. That 113% contract expansion is the signal in the noise. If they survive the spring, the Workday migration tailwind could carry them to a valuation that makes today's price look like a steal.
And I conclude that the signal is completely drowned out by the noise of the S1. The stock has become a financial vehicle for warrant holders to exit, not a reflection of the business. With a reverse split looming and negative EBITDA, the gravity of the situation and the sheer weight of those registered shares suggests the equity value will continue to grind lower.
We're going to find out very soon. The next few weeks are definitive.
Agreed. Watch the 31-cent level and watch that April deadline. That tells the whole story.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya!